So let's just talk about some of the shelters right now. Okay, we don't have a lot of tax shelters left in Canada. I hate to use the word shelters. Let's say tax exempt strategies.
Mhm.
Okay, the government's taken away non-CCPC planning, a whole bunch of different things. So, so the things that have no tax right now are your principal residence, right? So you buy it, you sell it. There's no tax for now. They will be taxing it. Just future attractions. Second thing is TFSAs, right? TFSAs, they allow you to, but the downside is you can only put $7,000 a year into it, right? So that's another thing is if you're a business owner and you have a CCPC, a Canadian Controlled Private Corporation, you're entitled to a $1.25 million lifetime capital gains exemption that you can multiply for your whole family. That's big numbers that people should be aware of. Philanthropy, giving to charity, actually is a great tax strategy as well because you can use charitable donations to mitigate up to 75% of your net taxable income each year. And on death, charity can be used for 100% mitigation against the state taxes. And then the last thing of the five that are left are tax exempt life insurance. So life insurance, most people have a lot of baggage with insurance. They think of it as kind of a grudge purchase, like their car or their house insurance. It's for, my mortgage and my young kids and putting food on the table. And yes, you have to have insurance for that. But for more sophisticated people, life insurance is something that's a very essential way of keeping taxes for yourself and your family. So if you have any of these five things, any of them, the government has their hand out and wants to share in your success. So I think it's really important for people to understand. And let's just talk about the life insurance for one moment. You likely have a TFSA, right? I mean, I know you invest, right? So most people right now, TFSAs have surpassed RSPs in Canada. So why do people like TFSAs? Because your money grows tax free. What's the downside of a TFSA? You can only put in $7,000 a year.
Right.
So if you knew that there was a TFSA that you could have for yourself or for your business, where there was no limit, you could put as much money into it as you wanted. Your money grew tax free. You could access that money tax free and you could pass it along virtually tax free. Isn't that something you might be interested in? Most
Very
people would
cool.
say yes. And they'd say, wow, I didn't know you could have a TFSA for your business. Well, you can. That's called how corporate life insurance works. Corporate life insurance, that's the nature of it. And there are ways to pay for it, either out of cash flow, right? Which a lot of people don't have a lot of, or they move taxable assets into this sheltered asset for themselves. Or you can actually do it even on a financing basis. And you being in real estate, you know the power of financing. You buy a piece of real estate, it's got a market value and it's got equity, and you can borrow against that equity to purchase more real estate. And you now can deduct the interest and some of the other costs, but your market value goes up, your equity goes up, and that's how you build a portfolio. So the same thing goes on the life insurance side. You can actually acquire life insurance using financing arrangements as well, which allows you to keep your money instead of it going into premiums. It can be used for investment purposes and there are deductions, but that's not for everybody. That's for somebody who's more sophisticated, has a healthy place to invest their money, appreciates the idea of deducting interest and stuff. But those are just a couple of ideas.
Now, let's say if the individuals are like kind of going paycheck to paycheck, they don't have a lot of disposable income and whatnot. How do they get into like estate planning and into tax minimization and like insurance and all that kind of stuff?
Let's talk about the civilians out there, okay? So there are two types of people. One person is somebody who spends every month and they save at the end. For most of them, they have more month than money, okay? Because they're spending first as opposed to saving. Whereas there are other people who save first. So they put aside a certain amount every month and then they spend to their heart's delight. That first group represents 96% of the population, unfortunately. That means and the second group represents 4% of the population. Most of the time, that first group works for the second group, right? But in order to get there, you don't need to be, a CPA or a tax person. You just have to know certain things. I call it like kind of like four buckets that you have to look at. One is you need to have access to an emergency fund. You need to have that means either money in the bank or credit that allows you to cover yourself for 3 to 6 months in case you ever have to take a time out. Most people are living on the line. They're stretched
Right.
out. So that's a secondly, debt reduction. People, there's so much debt right now in Canada. And when you're paying 21% interest on interest that's not deductible, that's not a good investment. So we want to make sure that you're living within your ability. Don't overdo it. Okay. The third area is really where all your investments are going to go on. That's 90% of your activity. It's going to be, investing stocks, bonds, RSPs, RIFs, TFSAs, real estate, commodities, whatever it is that you like. And that's another area that you have to be mindful of. And then the last box is really the estate planning box. What if you don't have time to do all that? So if something happens, you might, you got to make sure that you have a will, you have powers of attorney, your ownership. What happens if you get sick? Disability insurance, critical illness insurance. So those are the four things. Now, you asked me, how does somebody who's a civilian get to that place? Well, the first thing is you have to decide how much can you pay yourself every month. So if I ask somebody to say, here, can you pay yourself $10,000 a month? They'd say, are you crazy? I can't do that. But could you pay yourself $100 a month? They will likely say yes. So what number between 100 and 10,000 can you pay yourself? Let's just say it's $1,000. So then what happens is you have to allocate that $1,000. Is it going to be towards emergency money? Is it going to be going towards an RSP or a TFSA? Is it going to go towards paying for life insurance premiums? But at least now you've got a plan. And the key also, when it comes to this planning, is you want to set things up that the money is not always so available to you. Like, in other words, it's kind of like, if, let's say you have a can that has a lid and the lid only opens when you put money into it. Now the lid closes. Well, now that allows you to accumulate. If it's too available to you, then we're going to be reaching into it every day to buy a boat or a new coat or a moose knuckles. Well, I don't know, one of those nice jackets that people. But so it has. But that's why it kind of requires you to sit down with somebody, a financial planner, who can understand you and your family, your dreams, your wishes, gather all your information, make sure that you're being as efficient as possible, make sure that you have all your risk management looked after, and making sure that you're very tax efficient. But that's kind of like a simple, I would call it a estate planning 101.
Right. And